Hello, Frank. Can you believe 3 months of the year is already gone? The year is really flying past, and but there's some themes that are interesting.
Yes, Theo. I mean, we're already into April. I can't believe it. What do you think are the key themes that are arising and worth discussing today?
Frank, I think locally, obviously, it's the election. We probably we're less than 2 months away from the election. So locally, that always plays a role in how people feel about the election or what they expect of the election. Secondly, internationally, if you talk about geopolitical elements, the one element that is having an impact on specifically international trade is the fact that ships can't go through or are uncomfortable to pass through the Suez Canal, which means there's changes in shipping lines. Then from a market point of view, there's two massive themes that are dictating markets at this point in time. It's firstly the US interest rate cycle, and the expectation that we would have seen rates being cut by now, the fact that it seems that the rates will only come down later, and there's still this argument as to when and how deep will it come down and what the implications of that is. And the second point is the new highs we're seeing specifically in the US market is driven by AI. And AI and the big technology stocks are running away with international markets. So from a global theme, market theme, it's this interest rate expectations. When will it come down? Number one. And number two, AI and the effect that has on global valuations and global market performance.
Yeah, great, Theo. So let's jump into some of those themes. I mean, maybe starting with the South African elections coming up in May. What are your thoughts there?
Look, I think we need to be very careful. There's almost a kind of a silly season when we are in this election mode. Politicians make promises. Remember, politicians only focus now until the election is to get votes. It's almost like going for a job interview and you don't know if you're qualified or not, but you just got to get past the interview. That's all that this is about. So be very careful. What that leads to is promises and pronouncements that might scare you, that might scare financial markets, but remember, it is electioneering. And in South Africa, we have a history, well, not only in South Africa, worldwide, where election promises are not always what happens, and one needs to be very careful. That's the one element. So be careful for election promises, for electioneering, for what's written in the manifestos. That doesn't always come to fruition. The second point is, we are also seeing a lot of analysis as to where people are going to vote, what the expected turnout is going to be, what the polls are saying beforehand. Now these polls, one must be careful. We've seen specifically in the last number of years that one shouldn't put too much emphasis on what the polls say. The poll is not the election. The election is on the 29th of May. Before that, people might or might not tell the truth to pollsters, and polls are historically, there's an element of flaw in polls always. So, but what we know from the polls and specifically from the midterm elections, certainly the ANC's percentage of the vote has been coming down for a number of elections now, and that trend will continue. There's no reason to expect that trend not to continue. So where will the ANC end? Well, I actually don't know. All I know is that the trend of the ANC's percentage of votes are coming down, and it has been coming down for the best part of 20 years. That'll continue. Will that lead to the ANC go below 50%? Well, most of the polls say yes. How far below that? That is uncertain. Some polls say a lot, some polls say not that much. That's the first element. The second element, I think, if you talk to specifically some of the politicians involved, the ANC's absolute last choice of coalition partner is the EFF. And you will almost know that if the ANC has to form some kind of coalition with the EFF, it means that the other parties, almost all of them, have said no. So I think that's a very small chance. If the ANC is just below 50%, the coalition will be with some of the smaller parties, and there the IFP comes to mind as almost the easier choice. What this also will mean is that in not only in the Western Cape, where it seems that the DA will still be the governing party, but it seems that in KZN and in Gauteng, the ANC will not get a majority and some form of coalition will govern. The wild cards are, what will MKD do? We've seen them very strong in by-elections in KZN. What will they do nationally and what will they do in KwaZulu-Natal? It is difficult to predict at this point in time. Secondly, there's quite a number of smaller parties that came into the fold, and I'm thinking about Rise Mzansi and Action SA. How strong will they be? Will they get substantial votes? So there's a lot in play. I think be very careful to build any portfolio decision based on your ability to guess what's going to come out. That's very difficult. We don't know what's going to come out. Rather focus on structuring the portfolio and making sure your exposure through asset classes will take any of these considerations, will be able to survive and still get the outcomes, whatever the outcome. But Frank, let's move on towards the next topic, and that is the specifically international trade that's been disrupted by what's happening in the Red Sea and specifically the usage of the Suez Canal.
Yes, Theo, I want to get into the disruption that's happening in the Red Sea, but I think before we get there, it's important to understand that the disruption in the Suez Canal is part of greater shifts in trade at the moment. And if you think about sort of pre-COVID, the major trading partner of the world was China, and we had this terrible virus that broke out in China, and we had all that disruption around trade during and after COVID. And so there are a few key shifts that are happening in global trade at the moment. The first is this term friendshoring, and it's as we've got more and more political tensions around the world and around global trade, there's sort of a realignment of trade networks to geopolitical lines. So as the US and China tensions have built over the years, those parties have started to trade with more friendly geopolitical partners. We've seen the US trading a lot more with Mexico and Canada. Also, if you think about another example is the Russia trade divergence. And so Russia's trade politically, certainly after the outbreak of the Russia-Ukraine conflict, you've seen Russia trading more and more with its partners, with the BRICS countries. So on the one hand, you've got this sort of friendshoring and trading happening more and more with friendly nations. And on the other hand, you've got the rise of India as a trading partner. You know, they've got a low cost structure. They've got an increasingly capable workforce. Their logistics are improving year on year. And because of the risk of having one main trade partner, India is becoming the China plus one destination for global manufacturing. And so you've got these kind of bigger shifts in global trade. And then off the back of the Israel-Hamas conflict, you've got these trade disruptions happening in the Red Sea. And so since the outbreak of that conflict, the Houthis have been attacking commercial vessels that they seem to be aligned or feel are aligned to Israel in that conflict. And just to give you an idea of the scale of that disruption, so through the Suez Canal, there are 17,000 ships passing through that canal every year. That's 12% of global trade, and that's almost $1 trillion worth of goods that need to pass through the Suez Canal. And so the disruption and ships having to now take alternative routes, for example, around the Cape of Good Hope, is adding significant time. So, for example, if a ship was traveling from Taiwan to the UK through the Suez Canal, it would take that ship 25 days. To come around the Cape of Good Hope is 34 days. It's 10,000 nautical miles direct through the Suez Canal and 13,500 nautical miles around the Cape of Good Hope. And they estimate that for every ship to take the longer route is around $1.5 to $2 million per ship additional cost for that route. And so this conflict in the Red Sea is resulting in, firstly, a delay of goods, but then secondly, additional costs in the moving of those goods from one destination to another. And that's putting added pressure on inflation. And so these are just, these are the current state of affairs that's happening with these trade disruptions. And maybe that's a good segue into the next key discussion you want to speak about, which was US inflation and what's happening in that part of the world at the moment.
Yes, Frank, when we started 2024, economists, commentators, market participants was very optimistic that we will see sooner reductions or a turning point in interest rates in the US. We haven't seen that yet. And the key element around that is the US economy, number one, is a lot stronger than people anticipated. We see stronger GDP growth numbers. But number two, inflation is not coming down to the levels that the Federal Reserve wants it to be. Remember, the Federal Reserve long-term inflation is 2%, and they've stated it very clearly and very aggressively. They want to get inflation down to 2%. And while we are seeing inflation just above 3%, we are not seeing it coming down to the levels that the Federal Reserve wants inflation to see. The base case, or let's say the case is still that we will see interest rates coming down later in the year. It's just a question of when. And it's now very much based on every single month's inflation data, US economic growth data, employment data that determines that. The core element behind that is that once we're starting to see the first drops in US interest rates, that will almost be a trigger worldwide for the scenario of high inflation, hikes in interest rates are starting to turn. And I think that critical point will have a big impact on not only bond yields worldwide, but also equities worldwide. But that whole process is very difficult to predict. Market participants, the economists so far was a bit optimistic. They expected it sooner rather than later. And this whole thing about higher for longer seems to be the prevalent best case at this point in time. What is true is that we are seeing that inflation has peaked worldwide and interest rates have peaked worldwide. The question is, when do we see that coming down? And that's difficult to predict, but what we can say for certain is we are at the peak unless we get a massive new shock, which is not really expected. So we'll have to wait and see, and it will be determined on numbers. But Frank, that's the one driving force. The other driving force is this massive run in any stock related to AI. And that's why a lot of markets, specifically markets with technology stocks, are making new highs.
Yes, Theo. And I was looking at those numbers today, and I couldn't believe it. So, there are 7 companies in the States, and they're called the Magnificent Seven. And in 2023, those 7 companies gave a return of around 107% for those 7. Now, 6 of those are very well known. We've got Microsoft, we've got Amazon, we've got Alphabet, which owns Google, we've got Tesla, we've got Meta, which owns Facebook. But there's a 7th company called NVIDIA. And NVIDIA was the darling of the lot in 2023. If you had invested in NVIDIA, you would have received a return of 239% for the year, which is incredible. And you're right, this is all driven by the excitement around artificial intelligence or AI. And put simply, AI is the simulation of human intelligence in computers. It's empowering computers to do tasks which generally you would have needed a human to do. Solving problems or reading text or even drawing pictures. The AI technology, it's incredible to see what can be done through AI. And shareholders are getting really excited about AI and the returns that these magnificent companies can give you by offering AI products and services to their customers. Now, if you think about AI as a gold rush, NVIDIA is the company that's selling the shovels. So the other 6 companies are all going to offer AI products and services, but NVIDIA provides the computer chips that power this revolution. And how did they get here? Well, NVIDIA started out as a company that produced graphics processing units, GPUs, and these were initially primarily used to power video gaming graphics cards for your screens. And as you can imagine, these needed to be powerful and they needed to be fast because you needed to be able to render the game in real time to people who were playing the game. And then NVIDIA realized that these were such powerful and fast chips that if they released a coding language, these chips could be even better than the CPUs, the central processing units, that were kind of the prevailing technology at the time. And today, most cloud-based computing services use NVIDIA chips, as do Tesla's self-driving cars use these chips. And there's so much demand, particularly in the AI data centers for these chips, that NVIDIA can charge up to $40,000 for a single chip that are used in these data centers. So there really is a lot of excitement around AI. But the question is, is this sustainable? Firstly, the share prices of these 7 companies have really accelerated and have run over the last year and a half. And if you look forward, are these sustainable share prices? They're expecting incredible returns coming out of these AI companies going forward. And it's yet to be seen how these companies are going to be able to monetize these AI products and services, and whether they are going to get the returns that the market is expecting. And so, again, in terms of the way that we think about investing, we don't want to pick a particular stock like NVIDIA. We don't want to even, pick only the 7 magnificent shares that are doing particularly well. We look at our portfolios and ensure that clients have a well-diversified portfolio with some exposure to shares that might benefit from AI. But a lot of companies are in our portfolios that, kind of are consumer goods or financial companies. They're providing other services. They don't rely on this AI craze going forward. So that's just an interesting kind of view on the world of AI and what's happened in that market over the last 12 to 18 months.
Yes, and I think the key message there is that one needs to be very careful to base any portfolio decision on the assumption that the stocks that have performed in the last year or the last 2 or 3 years will still perform in future. History tells you that the risk increases if you were to try to follow stocks that have done bad, or even investment funds that have done great in the past, to assume they will continue. And it's all about the balance in the portfolio between asset classes, between geographies, and simply making sure that the underlying structure of the portfolio is structured in such a way that it will achieve your goals within the risk parameters that you're comfortable with. Well, Frank, this was a great discussion. Thank you very much. And let's see. 3 months is gone, and let's hope that the rest of the year is a bit less exciting and a bit more comfortable and predictable.
Thank you, Theo.